So Greece has a new government, and it's a government that is Europe friendly. It's a government that promises to stick to the austerity terms. There will be some forgiveness. They will ask for some adjustments to the terms, possibly some more time to repay. They are going to need it because structurally it looks a certain possibility that they will be able to commit to the current terms. But it buys Europe just a little bit more time, and where they can focus on possibly what will be the key issues of Spain and Italy. And there was a much shorter period of calmness just post the Greek election results, which should have sent equities higher. It was just a quick glance at Spanish yields that really caused concern in those early few days, and that is where I think minds are being focused. It was the Italian Prime Minister that proposed that the bailout fund of the EFSF, soon to be renamed the ESM, could be used to buy bonds. This obviously is as a solution. It doesn't, for me, seem the most sensible route going forward because it doesn't resolve the underlying issues, but it has been good enough to just put a bid back into some of the Spanish bond markets and to some extent take away the heat that was building in the early part of the week. So let's just take a look at some of the charts. Interestingly, in the run-up to the Greece elections, where tension was at its highest, we did see the FTSE and other global stock markets rising in advance, and to some extent I think this could be put down to the fact that the market was technically very bearish. There were a lot of short positions, and as the market started to turn, I suspect there was some forced covering of short positions, which added to the momentum of the upside. It's been interesting to see that actually post the result, a result that was wanted by markets, we have seen some slippage in equities, and indeed we'll come on later to currencies where we've seen similar trends. So, as I say, it was a case of buy the rumour and sell the fact, which was driving markets during the course of last week. Let's take a look at those Spanish yields, and you can see there that the peak was 7%, but it was post the comments regarding this bailout fund, which has driven yields back to 6.45%. I'm not necessarily sure that gets particularly far, even if they will condone the use of that bailout fund. It still doesn't go to the heart of the problem in Spain, which is an economy that is continuing to run at excruciating high deficits to its sort of economy, and that doesn't look like it can be resolved in the near term. So, as I say, it's sort of a chart that is extending to the upside, and I think we'll revisit those highs at some point in the not too distant future. Just turning briefly to some of the corporate earnings, I want to pick up on this as potentially a growing theme, because we've been arguing that all of this uncertainty around the European situation is beginning to weigh on the economics of businesses, and we've seen a growing number of profit warnings that are coming through, and indeed they're coming through from sectors that you'd be least likely to show up first on this, but some of the consumer staple stocks have begun to warn. The first was Danone. This is a French stock. They produce things like Evian water and Activel health products. One could argue that these are not essential food products, but nevertheless there's been a notable downturn. They described it as swift downturn, certainly in some of their southern European exposures, and that caused quite a sharp profit warning and indeed quite a sharp reaction to the stock price. That was followed fairly quickly by Procter Gamble in the US, also warning and citing their developed markets as being sort of cause for concern. So they're seeing downgrades to their earnings. Over here in the UK, we do have companies like Unilever and Reckitt Benckiser. Both stocks have not said anything at this stage. One would argue that Unilever is better exposed to emerging markets. One could also argue that Reckitt Benckiser possibly has more essential products, so may not need to warn on profits, but nevertheless the ratings on these stocks, which have been classic defensive homes for investors that have to be in equities but want to be at the defensive end, may come under a little bit of pressure in the near term on their rating as I say, as these warnings start to build. Be aware that we are entering into the US reporting season within 2 weeks' time, and I think we're going into it with just a little bit of more hesitancy that the numbers there could be disappointing on that front. So let's watch that with a little bit of interest. Just a quick glance at at some of the currencies, I think it's worth observing that sterling is holding quite well. That's despite the fact that inflation last week came in at 2.8%. That was at the low end of the forecast. We also saw the Bank of England minutes, which highlighted that 5 voted for no further QE at this point, but 4 did. And I think it was that sort of split of vote which caused the market to suggest that QE is possibly less than a month away for the UK at the moment. And that just weakened sterling off a little bit towards the close of the week last week. In terms of the euro, similar pattern to that equity story I was telling you last week. It was a run up to the Greek elections, but we have seen a little bit of sell-off coming on. Again, the euro position has been incredibly short, technically short, and therefore we are going to be prone to these short squeezes. So I think we need a bigger picture to see whether the euro has got any longevity to its strength at the moment. The early signal is that looked like just a squeeze on the short positions. Just a couple of stocks to mention. Home Retail, that's the owner of Argos. They produced some numbers that came in line with expectations, but purely by coming in line with expectations, I think the stock had a very, very strong spike up from 70 to 90 pence, reflecting the fact again that a lot of these stocks are shorted by many hedge funds at the moment, so you do see a squeeze on the stock. It is coming back. One stock which is a bellwether for the retail market and coming under a little bit of continued pressure at the moment is Marks and Spencer, and that is coming down to a low of the year around 320, so watching that one with closeness. And the final chart for me today is to do with the oil price. I think it's worth just looking at the weakness we're now beginning to see in oil. This is was trading at around sort of 125 in March, down now to 90, so we've seen a very significant depreciation in the oil market. This is good news. It's helping with inflation at the moment. It's certainly just relieving some of the pressure on the squeezed incomes of consumers, particularly in the US, as they enter into the sort of key driving season at the moment. So may give just a little bit of a boost to consumer expenditure when it most needs it.